In late 2019, international criminals drained $272 million from a single corporate bank account. The victim, Essilor, the company behind Ray-Ban and half the world's eyewear. They sued JPMorgan for ignoring what they called obvious red flags. What happened next reveals how your business accounts might be at risk right now. I spent months analyzing court documents to understand exactly how this massive fraud unfolded. Essilor operates a major manufacturing plant in Thailand, producing high-end Ray-Ban frames. This subsidiary maintained a US dollar account with JP Morgan in New York for paying suppliers. The account had dual authorization controls, meaning two people had to approve every payment. For years, the account operated normally, processing about $15 million in monthly supplier payments. Then in September 2019, something changed. The criminals had found their way in. First, they targeted the plant's chief financial officer through a romance scam. Using emotional manipulation, they gained the CFO's trust and influence over the finance team. They recruited a senior finance manager who had access to the payment systems. This insider stole the login credentials of the second approver, defeating the dual control system. With both approvals under their control, they initiated the first fraudulent wire transfer. Over 3 months, they sent 243 separate wire transfers. The monthly volume exploded from $15 million to over $100 million. The money flowed to accounts across Thailand, Malaysia, China, Hong Kong, Indonesia, and Dubai. The receiving companies were bizarre: camping equipment dealers, furniture stores, coffee shops, hair salons. None of these businesses had any connection to optical manufacturing. They were obviously fronts for moving stolen money. Every payment was a round dollar amount: 50,000, 100,000, 200,000. Real invoices are never that clean. The account repeatedly blew through its $10 million overdraft limit, sometimes by $20 million or more. In the account's entire history, this had never happened before, not even once. The money went to small regional banks in high-risk jurisdictions, not the major banks Essilor typically used. The criminals operated like clockwork, sending large batches of transfers almost every single day. Meanwhile, JP Morgan's monitoring systems processed every one of these suspicious transactions without raising a single flag. Modern anti-money laundering systems are specifically designed to catch these exact patterns. A 600% increase in payment volume should trigger immediate investigation at any major bank. In December 2019, after 3 months of bleeding money, someone at Essilor finally noticed something was wrong. The damage assessment was devastating. $272 million had vanished from their account. Essilor launched an aggressive global recovery effort, working with banks and law enforcement across multiple countries. They managed to claw back $172 million, but $100 million remained missing. Thai authorities arrested the insider finance manager who had executed the transfers. Internal investigations revealed multiple employees had colluded to bypass security controls. The dual approval system failed because one person controlled both sets of credentials. In April 2022, Essilor sued JP Morgan in New York federal court for the missing $100 million. They argued JP Morgan violated banking law by processing clearly unauthorized payments. Essilor listed the red flags: volume spikes, overdraft breaches, new recipients, wrong industries, round amounts. JP Morgan's defense was simple: valid credentials were used, making the transfers legally authorized. They argued Essilor's own employees caused the loss by circumventing internal controls. JP Morgan emphasized they helped recover $172 million after the fraud was discovered. In January 2023, Judge Louis Lehman made a crucial ruling that would shape the case. The judge allowed Essilor's main claim to proceed, finding genuine dispute over authorization. However, the negligence claims were dismissed. Banks don't owe a general duty to monitor for fraud. The case moved into discovery, with both sides gathering evidence about the fraud and banking practices. Banking experts were brought in to testify about industry standards for fraud detection. From the first fraudulent transfer to the case closure, this battle spanned 5 years. In December 2024, the federal docket was quietly closed without a public trial. The lack of public verdict suggests a confidential settlement was reached between the parties. Whether JPMorgan paid anything, and if so, how much remains sealed from public view. The first lesson is clear. Never let one person control multiple approval credentials, no matter how trusted. Offshore manufacturing facilities need extra oversight. Distance creates opportunity for fraud. Finance executives are prime targets for romance scams and social engineering. Personal security training is essential. Your company needs its own transaction monitoring. You cannot rely solely on your bank to catch fraud. Implement behavioral analytics that flag when approved users suddenly change their payment patterns. Understand exactly what your bank will and won't monitor. Get specific commitments in writing. Courts generally side with banks when proper credentials are used, even in obvious fraud cases. Set hard overdraft limits that cannot be exceeded without multiple executive approvals. Have a fraud recovery plan ready before you need it. Speed matters when tracing stolen funds. Review your crime insurance coverage. Many policies exclude insider fraud or have low sublimits. Train your finance teams to recognize these patterns. Round amounts to new vendors should trigger immediate review. Every new payment recipient should be verified independently before the first transfer. Payments to certain jurisdictions should require enhanced approval, especially in Asia and the Middle East. Implement daily transfer limits that match your actual business needs, not theoretical maximums. Large payment volumes require continuous monitoring, not just end-of-day reviews. Senior executives must understand these risks. Fraud prevention requires top-down commitment. When fraud hits, every hour counts. Your response plan determines recovery success. Document everything. Your ability to recover funds depends on the evidence you preserve. Modern AI can detect these patterns instantly. The technology exists, but you must implement it. Different regions have different fraud risks. Your controls must adapt to local threats. Complex supply chains create complex fraud risks. Each payment point is a potential vulnerability. Banking regulations are evolving, but they still favor banks over corporate customers in most jurisdictions. Fraud techniques evolve constantly. What worked yesterday may fail tomorrow. Beyond the money, fraud destroys trust, damages relationships, and diverts resources from growth. Every dollar spent on fraud prevention can save hundreds in potential losses. According to FBI IC3 reports, corporate account takeovers cost businesses billions annually. Your business could be targeted next. The question is, will your controls hold? Start today. Review your controls, verify your vendors, and strengthen your monitoring. Essilor survived and strengthened their controls. The question remains whether JPMorgan paid for missing the signs. This case may reshape how courts view bank obligations when obvious fraud patterns emerge. Don't wait for fraud to find you. The patterns are clear, the risks are real, and the time to act is now. Remember, in the battle against fraud, your best defense is assuming you're already a target. Subscribe for weekly fraud intelligence that could save your business millions. Stay informed, stay protected.